Good morning or afternoon. This is Bob Sargent, co-founder with Josh Hollander of the ITA, and welcome to our webinar today. We'll give it a couple of minutes to let everybody join and get settled, and then we'll start. Welcome. So to start, Josh is going to walk us through some of the some background on ITA. Josh, you want to take it from here?
Yeah, great. Thanks, Bob, and thanks everyone for joining today. Looking forward to this session and kind of kicking off this program. Perfect. So about us. So we are a US-based not-for-profit community focused on innovation in insurance. We're an inclusive community, open to all, but certainly looking to support companies that are innovating at the earlier stage, and then all the ecosystem partners around that. What do we offer? So we're trying to offer community. So there's lots of excellent resources available within InsurTech. But many of them are kind of discrete in format. And so we're trying to provide a community that makes connections across the ecosystem by building relationships, providing learning through experts like the folks we have on today's session. We're doing some special things around regulatory and AI. Obviously it's a highly regulated industry, and AI is a huge topic right now as to how to handle that. And so we're doing some special content on that, and then we're offering working groups as well. Next. Can we get the next slide? There we go. So as I mentioned, we're an inclusive group. So, at the core, a lot of our members are earlier stage insurtechs, but we have later stage folks as well, traditional insurers and MGAs, investors, both angel and professional, folks on the distribution side, agents and brokers, other vendors and consultants in the industry, some other finance professionals, and then, linking together with some of the other communities that are out there in the industry. Next. We're lucky to have some great sponsors on board, and so thank you to our founding sponsors who initially helped us get up to speed. And we just launched a new website which is live now, so if you haven't seen it, please check it out. I think it's a better reflection of what we offer. It includes things like member spotlights, some of the different types of events we're offering, like webinars that we have today, as well as in-person networking and regional dinners that we're starting to offer, other member resources and benefits, looking to drive increased engagement with insurers and other members of the incumbent community. And then we also have something called the InsurTech Growth Network, which is a mechanism to enable companies looking for early stage angel financing to be able to pitch and connect with investors who are experienced in the space and familiar with the requirements of investing in insurtechs and what those businesses need to do to be successful. So again, here's the website link. You can also email us at info@insurtechassociation.org, but please check out the new website. Any questions, be happy to discuss how we can help you, how to help you become a member, or if you're interested in sponsoring, what the different options are.
Thanks, Josh.
Yep.
Thanks very much. Appreciate it. And welcome to our ITA webinar. So you want to start an MGA. Our topic today is starting an MGA, what you should do, or maybe what you should have done, depending on your stage. Today, we have two distinguished experts to share their experience and wisdom. Somil Jain is a credentialed actuary and InsurTech aficionado. He has been in the insurance industry over 25 years with experience at some of the biggest names in the business like AIG and Travelers. as well as InsurTechs, where he held co-founder and chief actuary roles. He specializes in helping emerging MGAs and carriers create profitable admitted or non-admitted insurance products. Somil also holds an MBA from Wharton with a focus on direct-to-consumer marketing. And John Willemsen is joining us as well. John is the founder of Willemsen Advisors, a consultancy providing strategic counsel to MGA and program administration organizations. He specializes in a range of functions, including market entry, operational efficiency, distribution strategy, and revenue growth initiatives, guiding his clients on positioning, execution, and long-term alignment. John has advised many MGAs at various stages across multiple classes and lines of business. He has played a key role in launching several insurance companies, including one that went public. So thank you both for joining us today. So let's dive right in.
Let's do it.
Here's a question. What is the first thing an MGA founder should do? Who wants to go first? Flip a coin.
I'll take a stab at it. We'll start and then Somil can join in. I think that first and foremost, right, Bob, I think they should just take a pause for a moment. Think about what it is they're about to do. And let me set the stage a little bit early here. Sometimes when you speak with carriers, recognize that interest does not necessarily mean contract. When people are speaking with carriers, I have seen a number of startup MGAs or early MGAs going through a process where they think they're about to get a contract. And really what they have done is they haven't provided the carrier enough information to actually accept the account or decline the account. They get a lot of smiles and nods, but what you have to do is provide them with the information that's going to be necessary. I think the other side of this is the operational lift, right? Recognize that the operational lift is going to be heavier than what you probably anticipate. It's going to take you a minimum of 3 months to probably get to contract, and it can take upwards of 9 months. And then when you bring in the rest of that, all the other information that you're going to be required, you can add on some other time there. So just recognize that the time to be spent is probably going to be a lot longer than you anticipate. And then I would say recognizing the moat that you're going to need, right? A minimum of probably 1 year. And I would even recommend perhaps 2 years of float that you could probably achieve to support yourself and all those soft costs that go along with that.
Thanks, John. I'll add to that. I think from a technical perspective, there's a lot of work that needs to be done to get an MGA going, right? But the point is, it's been done before you can do it. It can be done, right? The biggest thing that I would say a founder should do is find your tribe. Like find your people, find the people that are going to support you. It's going to be tough. There's going to be disappointments. It's going to be a roller coaster, right? There's going to be a lot of challenges. So you want to surround yourself with people that are going to help you think through that are going to help you kind of face the emotional side of those ups and downs. So just find your tribe, find your support system, find people that are going to help you get there.
So I want to circle back on something that John said directly, and Somil, you sort of were heading at it as well, and that is what impacts timing. What are the pieces that can accelerate the process? What are the pieces that can slow it down? And how should a founder be thinking about those?
Look, I think that there are a number of reasons that things can slow down or speed up. And a lot of that has to do with the expertise that team has and the information that they have. Many startups that I have seen personally come into the marketplace with half of the data that they probably need or no data that they probably need. And that's going to slow the process down tremendously. And you've got to be able to back up all of the things that you're stating within your deck with either other data or other supplemental information that could help bolster up your deck. But at the end of the day, those are things that's kind of like tend to slow things down. Underwriting expertise, of course, is going to be critical in all of this as well. And I think that probably slows things down, admitted filings and all the other things that you're going to need. Somil?
Yeah, so in terms of what slows things down, right? I'm going to flip that around and say, what's the most important thing you need, right? and which in my mind as an MGA is capacity. That is the single most important thing you need. Without capacity, you're not an MGA. You can't really do much.
Right.
So getting capacity, making progress in terms of finding your fronting carrier, finding your reinsurance panel, that is the biggest challenge you have. Right now, there's other things that feed into that, right? Do you have, exactly as John mentioned, do you have the data that'll support that? Do you have the underwriting firepower? Do you have capital, right? You're going to need some money to kind of put all these things together. A distribution channel. So you have to, all of these things have to come together. Any one of them can slow you down. And I think it helps to have a target. It helps to have a plan, so you know what those obstacles are going to be, and then how do you get around them.
So if you go to the very beginning where someone has a concept, what are sort of the first things that individual should do to start pulling things together?
I would start with, what is your idea and what is your differentiator in the marketplace? You are going up against a couple of thousand different programs in the marketplace. It's a $110 billion marketplace now. You have to have something that separates you from the rest of the pack. And what is that? That is one of the first things that I would try to do. Somil, what do you think?
100% agree with that. I'm not gonna. I will restate this only because most people will hear this being restated other ways. You're going to be asked, "What's your differentiator?" You're going to be asked, "What's your mode?" You're going to be asked, "What's your special sauce?" They're all trying to get to exactly the same thing, which is what John said.
I think we lost it.
Oh, can you hear me now?
Yeah, we got you.
I know something weird going on with my connection, but what I was trying to say there is you'll hear the same question being asked different ways. What's your differentiator? What's your mode? What's your special sauce, right? What's your secret sauce? They're all trying to get that, because if you build something that somebody can go around and replicate right away, well, you kind of don't really have much then.
I think we lost him again. So John, let me follow up on that. Sure. What are ways that a founder of an MGA at the early stage can start thinking about how that differentiator might translate into underwriting profitability? How should they, because I assume that that's going to be a critical question at the end of the day for the capacity. And if you can't show that, you're going to have a tough time getting that capacity. So how does a founder think about that in terms of the planning?
I think that as a founder, what you need to do is you need to have expertise in the insurance. You need to understand the regulatory side, the underwriting side, the product, the technology. All of that needs to come together. And then each one of those components needs to be backed up with some sort of substantive information that's going to help bolster your case. I think that a lot of you have to ask the question 10 times deeper is the way that I would put it. Every time you have a piece of data or information that you're going to talk about to a capacity player, make sure that you can go 10 questions deep with that and not just on the surface. You're going to go up against, if you will, when you speak with a carrier for capacity, you're going to talk to their chief underwriting officer who has probably multiple years of experience in the business and multiple years of experience within the MGA space. You're also going to be speaking to actuaries that have been here, done that before many, many times. And then you have the underwriters and then the rest of the team that may be part of this. You have to be absolutely prepared for that conversation. If you can't get through that conversation, I kind of look at it like strike two. You've got to be able to get through that. And if you don't have that expertise, take a pause, take a stop, really kind of figure out what it is that you're missing and enhance that.
So how is there a framework, sort of a high level framework that a founder should be thinking about in terms of those pieces? And I would assume that some of those pieces would be underwriting expertise, but also how to support that, where the data is going to come from, how the differentiators fit in there, but then things like team and distribution strategy and those kinds of things. How do those pieces, is there a framework, or how do those pieces sort of fit together?
That's a big question.
It is a big. So pitch it to Somil.
We'll get Somil back. Let him answer.
Are you able to hear me? Okay.
Yes.
I'm going to try to join on my phone and see if that works any better. Okay. So one of the things that I think it's important to understand where you are in terms of that
This is great.
Yeah.
That underwriting profitability is how do I show that that lack of insurance data can still be profitable, right? So you're having a very you're having a conversation around how do I use non-insurance data and work with the actuaries, work with underwriters to turn this into a profitable solution. On the other hand, if this is an advance of an existing,
Maybe Somil could join by his phone, so at least we have the audio.
Sorry, everybody.
Somil, do you want to try to join on audio on your phone?
yeah, let me do that.
Okay. So while he's doing that, John, how do you think when you're assisting an MGA founder at the earliest stages about the process of planning, making sure those pieces fit together, and obviously key components for an MGA are sort of the balance between team distribution and underwriting profitability? I know that's like a pretty general question, but when you're helping someone at the earliest stages, what's sort of the process?
I think as Somil pointed out earlier, right? I think the biggest thing that has to occur here, right, is you need capacity. Without capacity, you're not going to get anywhere. And I would say that there are probably some 25, even 30 different data points or points within a business plan that need to be there. And those all have to come in concrete, and they have to have data to back up every one of those different points. And that could be anywhere from, the data that you have, the resumes and the bios, and all of those other things that are required of a business plan. You have to be able to respond to the questions that are come in after that. And if you have all of that together, you can then confidently at least move forward to the next step. I often recommend do not move forward unless you can answer all of those questions and answer those concretely. A lot of folks will come in and what I would say is they chase out their favorite market, right? They come into the marketplace, and what ends up happening is that they don't recognize what they don't know. And so when a startup comes into the space, they come in what I would classify as half-baked. And then you sit in front of your favorite carrier. Why? Because that's the carrier I want to go and talk to, right? That's the carrier I want to do business with. So I go to whichever carrier it is that you say, right? And then they say, we like you a lot, but go back to the drawing board. There's 50% of your deck missing, and we need to understand the questions around that. They come back. And so that kind of process gets carrier fatigue as well. I would say you want to make sure that you are set up as best as possible to begin with. A solid business plan is the way to get everything rolling as best as possible.
Somil, do you want to join in, or do you want me to start the next question?
Let me make sure. Can you guys hear me okay?
Yes.
Yes.
Okay, this is good. We're going to stick with this then. So yeah, I agree with John. And I think the thing to understand is you're not going to have all of the solutions day one, right? But you need to know what will you be asked when you have that first date with a carrier, and what are you expected to then be able to develop on for the second date, for the third date, and so on, right? You don't need to have everything ready day one. It's probably not possible, but you need to have enough to make sure you get to that second date. And if you get there, it's a big if you get there, they're going to ask a lot deeper questions. So you need to be ready for those. Maybe you don't share everything yet, right? You think about when is the right time to have the NDAs and all those in place, but be ready to have much deeper conversations, be ready to support your assumptions, be ready to say, hey, not only am I going to get to X million dollars, here's my plan behind that. Here's what I validated already. And by the way, here's a few references you can go talk to kind of believe that, right? So you need to be ready for that.
Yeah, I think that if I could just pile on that a little bit more, if as a startup MGA, you talk to me and you say you're going to run a 57 ultimate loss ratio, tell me how you're going to get there. Why are you going to get there? What are the details behind that? Not just because you want to be there, but how do you expect to actually get there? And and that point, I think, echoes throughout a business plan. You have to be able to answer the questions, any numbers that you push out, any commentary that you push out. You've got to have the answers to that because, again, I have seen, and you've heard me say this before, both of you have, I've seen some 3,000 business plans of MGAs in the space. And what I will tell you is that so have many of my colleagues and peers across the industry. They're going to ask a lot of tough questions, and you have to be prepared for that. We ask questions about what it is you're stating, not because we want to be a pain, but because we want to understand exactly what it is you're trying to achieve and how do we make that work within the industry.
Yeah, but it's not all doom and gloom, because the good thing is it's predictable, right? We can tell you what those questions are. We can tell you exactly what you're going to be asked. And this is because it's the same kinds of things that you're expected to be able to do.
Yeah.
So we have a couple of questions around the business plan. They're in the chat if you want to read them, but how detailed should it be? And then where's the best place to find an underwriter?
Sure. I'll go. So the first one, I've seen people share models that'll get, here's what the next 120 months look like, and there's 40 tabs in that spreadsheet and everything links to everything else, and that's a disaster. I can tell you nobody's ever going to look at that. It's great that it gets you comfortable. That's wonderful. Nobody's going to look at that. You also can't just put a slide deck that says, hey, look at a trajectory. We're going to grow like a hockey stick, and that's your answer, right? So it's a great question, because you have to have that level of detail that says, let's say at an annual basis, you want to show, here's my premium for the next 5 months. Here's my average premium per policy. Here's how many policies I need to get there. Here's my expected renewals. You're going to base those assumptions and share what those are. You want to show exactly as John was talking about. If you're talking about a 57 ultimate loss ratio, how am I going to get there? Here's some sensitivity around that. What if I hit a 50? What does that mean? If I hit a 65, what does that mean? Is this a cat exposed line? In that case, you're going to have a lot more variance, right? So you want to bake all of those things in. Doesn't need to have everything. Like I said, don't create spreadsheets that have, I'm going to say, more than 3 or 4 tabs. That's way too many at that point in time. You're going overboard for this initial meeting, but have enough support behind kind of all of those. Second question, and then I'll flip or let John kind of address those also. Yes, you need to have an underwriter early enough. You don't need to hire a full-time underwriter day one or even pre-MGA, pre-revenue if you don't have those kind of dollars sitting around, which a lot of people don't. Think about fractional. Think about people that can kind of help because they've done something like this before, and they can perhaps help you on a fractional basis until you get to the point of needing to make that chief underwriter or a lead underwriter hire.
I would add to that I always recommend folks start up very small. You are one person who has probably an MGA idea right now, right? And so you want to take that and capitalize on that. Before you start running out and talking to your friends about getting hired and coming on board, think about what it is you actually need. Maybe you don't require 2 underwriters, right? What you really need is an underwriter, ops person, and distribution. Distribution, by the way, is probably the #1 killer of most programs in the beginning. People think they may have distribution, and ultimately they don't have the distribution that they thought. We can prove out that they have the underwriting expertise and everything else that goes along with that, but distribution is a little bit more difficult. So really, when you think about your distribution, make sure you're double checking your assumptions on that.
So John, you touched on it a little bit, but another question is, what are the most common reasons MGAs fail in their first 3 to 5 years?
Let's make the assumption, of course, right, that you've gotten to contract and everything is going well or has started off well. I'm going to say that distribution is the #1 killer of programs that I have seen in the first couple of years. The assumptions that are made were wrong, right? You thought that you were going to get to $10 million in 18 months, but you're at 2. And that tends to be a big strain on the relationship because now you're punching out $1 million limits, $5 million limits, whatever it might be. That's not going to work from a profitability perspective. You need to get a lot more premium on there, but it's got to be profitable premium.
Yeah, Katie, I'll put it this way. In my experience, there've really only been 3. First, getting to year 1 is the biggest challenge, right? If once you get there, then I think the question around 3 to 5 years, here's the 3 things that I've seen kind of make MGAs fall apart. First, exactly as John said, distribution. You don't get to the scale, the volume that you promise, and therefore either funding gets pulled or capacity gets pulled or some combination of the 2. Second, you have the $10 million in premium you talked about, but you're running a 200% loss ratio. That's the second thing that's going to kill you. So if you're writing a lot of business, but it's a lot of unprofitable business, so you're losing money really fast, that's the second thing that's going to kill you. The third thing, this happens less frequently in that 3 to 5 year period, but I have seen it where the team or the founders kind of fall apart. So there's a breakup. Things are not as expected. The people had assumptions in the mind that were not written down in contracts, and somehow there's infighting and the teams falls apart. Really, other than those three things, if you pass those three things, I haven't seen a lot of other things that really make things be problematic, because you have capacity and you're doing well in terms of growth and you're doing well in terms of profitability. There'll be other people that want to get your capacity, so that should not be a problem anymore.
I would just add on to that if you're in the startup phase of an MGA, in addition to, if you're a very tech-centric, you want to have the underwriter there as well. And I think, as Somil pointed out earlier, right, get a friend in the business that understands the class of business, the line of business that you're doing, work together, and ultimately maybe together you form this MGA, but make sure that you have all the proper expertise that's going to be going through this with you. I can sniff out, or any of us can sniff out, if you will, any deck that comes across our desk that basically says, I know nothing about insurance, but I'm a very strong tech person. That's all great. And obviously we want a lot more tech in our space, but you have to have it backed up by some form of insurance expertise, whatever that might be. Again, as I stated earlier, you're going to be talking to a chief underwriting officer, actuaries. They're all going to want to understand how they're going to make money. And what I think we also need to recognize, carriers aren't necessarily patient capital. Patient capital comes with trust and time. When you come into this world, if you will, of the MGA space, then I think that some people think that they're going to just be able to sell insurance, right? And I think if you lack that expertise, it's going to be a challenge for you to come into this space big time.
So I want to follow up on this discussion. It's really interesting. I'm thinking of actually an MGA that did not quite make it. And so how does a non-insurance expert, let's say, someone with an idea and maybe has operating experience in the underlying business that's being insured, or a tech expert who wants to apply technology in an MGA structure, how does that individual find, obviously, an underwriter with expertise, but two things? One, find the right person that is not just an expert, but also is going to be credible with capacity, may be able to help with distribution, certainly can understand underwriting guides and structures and referral structures and that kind of thing. How would someone think about that? And then the second piece would be, how do you fit someone like that into a structure that is a new business? Obviously, one thought would be equal partners as an investor in some of these structures. I don't like equal partnerships for the reasons that both of you have mentioned, because it can lead to problems and without a good solution. So how does that individual without that expertise think about getting expertise and fitting that into their new organization?
Yes, Somil.
Sure. I'll talk about maybe two models here, because it's not one size fits all, right? Mm-hmm. You could find a unicorn. You could find that person who both has technical expertise in that particular line of business, right? So they're an underwriter, they're an actuary, they've kind of seen that space before, they get it, right? And they're also, again, if you're a startup, willing to work for cheap or free in terms of cash, right? Maybe they take equity, but they're not taking the huge salaries that some of those people have, because you probably can't afford that. And they are a good culture fit in the sense that this is not just a short engagement with somebody, you really want to be there. And they are both that operator. They can do hands-on work, but they can also lead and have conversations with capacity providers, conversations with investors. So I think I just listed 6 ands, and there's probably more. right? And that's why I say so maybe you get lucky, you find that unicorn. Maybe that person does become part of your founding team. So that's one option, right? So that if you get that, that's awesome. You're super lucky. Pursue that. Make sure you get that happen. But like I said, don't have assumptions. Write shit down. Like get all this in contracts so you can actually both agree, not just think you're there, right? Not everybody gets lucky. Second, if that doesn't happen, that's what I would say. Go down the route of looking for fractional or part-time or temporary or some sort of a contractual arrangement that gets you those pieces. And that may not be one person, that may be 2 or 3 people together, right? So you may have one person that is that senior underwriter or actuary with experience that can talk through and get in front of investors, get you both capacity and money. But you may have a separate person who is actually doing the day-to-day underwriting. That's okay. It is okay to do that, right? Down the road, you can build the right team around those people. But right now, you're talking about, hey, what do I need to get there? There obviously has to still be that cultural match, right? You can't have somebody who's just kind of doing things in a very different way than what you're anticipating. But that model also works. So you really think about where you are, and typically you'll end up kind of going down one of those 2 paths.
Yeah, I would agree with all of that. Yeah, perfect.
So, yeah, and shout out to Josh, because this is what he does, is try to find people that fit that model. So didn't want to let that go by. So I think it was you, Somil, but maybe it was John, said something that caught my attention. I wanted to circle back, and you mentioned NDAs. So what is the sort of standard in terms of expectation of carriers signing NDAs? When will they do it? Will some not do it? And I'm coming at an investing perspective where most investors not only won't sign NDAs, but they won't even guarantee confidentiality, which is a whole nother discussion we can have at another webinar. But talk a little bit about sort of what the thinking is with NDAs today.
I'll go. My experience has been I have no problem signing NDAs, and I expect other people to sign NDAs. It's really that simple in my book. Are they foolproof? Absolutely not. You're an idiot if you think an NDA piece of paper is going to protect you forever. No way. But if you are working with somebody, you're looking to share your idea, you're looking to share your data, you're looking to share any form of IP, and they're unwilling to sign an NDA, I would stay away, because that to me is a red flag right there. Now, of course, read the NDA, make sure it's mutual, no reason for it not to be, because you're going to be trading ideas, and have the expectation that you are going to be sharing some things that you don't want to be shared outside of the people who have access to it. That's it. That's an important conversation. If somebody doesn't want to sign an NDA, that might be the end of the conversation for me.
I would just add to that most NDAs need to be a 1 year, 2 year maximum for protecting the information, right? If you start getting like 3 year, 4 year, 5 year agreements, like it's really difficult to promise that nothing's ever going to get out. So it becomes an unreasonable request. I would also say that NDAs are meant to protect, right? And what I'm getting at here is that don't necessarily think that you have some amazing secret sauce that nobody's ever going to figure out. It's going to get figured out, and it'll get figured out relatively quickly. The day you issue a policy, everybody can figure out what it is that you've got. So take a bit of a chill pill and don't necessarily reflect too deeply upon what it is that you think you have. I understand it, I get it, but the second you start talking to people, you're going to have to like open up the black box and make sure that you can talk about that freely.
And this is where the execution piece comes in, right? Like if your idea is so easily replicable, well, maybe it's not that great, right? So there has to be some piece where, yes, it's a great idea, but you're also executing on it really well in a way that's harder for somebody else to kind of go after it.
Yeah. AT, do we have a question?
We actually had quite a few, but there's been some great discussion, so I didn't want to overly interrupt. But I'm going to back up to one asking, how do you identify the best carrier to approach?
The one that will give you capacity. No, I think that what you have to do, right, is figure out through some research, right? Figure out who it is, what is that carrier currently doing? Do they reflect your values? They reflect the class of business, the line of business that you're doing, or is there big red flags that they've never? Have informal conversations across the industry. One of the associations that I belong to, which is also very good, Target Markets, has a lot of different carriers out there. You can have a lot of different conversations with people. Make sure that they fit your box and that ultimately they understand the business. If you're going into, for instance, if you're an MGA and you want to get into commercial trucking, great, right? If you want to do that. But make sure that that carrier has already written a commercial trucking program. It's important that they understand what that class and line of business is.
Yeah, I'm going to put an asterisk to that, John, and I apologize if that disagrees with the way you're thinking about it. Not everybody has that option sometimes. I've been in situations where it's a brand new program and the only carrier that is willing to write it is a new fronting carrier, and that's the only reason they're willing to write it is because they're new, right? So that situation does also happen. So it is not a one size fits all. Everything John said is right. I think it's a dating game. It really is. You talk to a lot. I'd be very surprised if you talk to the first one. I have seen that happen once. You talk to the first one, they end up being the perfect fit. That's awesome. Doesn't happen that often. Most of the time you talk to several. And I'd say this way. It is transactional in the sense that you're typically writing 1-year treaties. However, you want there to be the ideal setup where they become a long-term partner. Can you change carriers after 1 or 2 treaty years? Absolutely, people do. It's a little bit of a pain, but it happens. Sometimes you get much better terms, or they stop writing a certain line of business and all that. All that stuff happens. So it's not a one-time thing. It can be a recurring thing. However, think about the long-term dating game, not the short-term game. Think about, I typically suggest people to use reinsurance brokers. They know the market. They know who's exactly what John was talking about. They know who's going to be writing what line, what kind of minimum premium expectations do they have? Do they like working with other reinsurers or not? There's a lot of things that come into play, but you have to ask a lot of different questions and check boxes on both sides before it works out. Most of the time, the answer you're going to hear is, it's a great program. Come talk to me in 2 years when you have experience, right?
So I want to circle back on that, but one other comment that's sort of related. How do you think about competition? So I hear you, John, and I thought, Somil, you were going to mention this, but if a carrier is experienced in long-haul trucking and you have a program in long-haul trucking, how do you think about whether that carrier might be an appropriate fit or actually might be a primary competitor to what you're planning on doing? And is that important?
It is important for both legal/regulatory reasons and then also for good business reasons. So the legal regulatory piece comes into play. Again, insurance is regulated at a state level, so you're going to get 55 different answers on this. But some states will not let you write within the same line of business 2 programs at 2 different premiums. That is not regulatory allowed in some states. Some states will let you do that. So that's one piece of it, right? Yeah. So if somebody is writing a long-haul commercial trucking and that state does not let you write in a second set of premium, that's not even an option. It's off the table, right? Some states are okay with that. This is where the business challenge comes into play. A lot of times the carriers are also not just providing the paper, but also helping you with distribution or helping you kind of make contacts, make arrangements. Do you want to be in a situation where you and your competitor are both getting adversely selected against, in this case, right? So policyholder comes in, they have a choice of 2 different premiums. Obviously, they're going to pick the lower. Everybody gets hurt in this situation. Like, this is not good for anybody, right? So there's that business reason to also think about being in that weird situation. Can it be done? Yes, I've seen it being done. Yes, sometimes successfully, because they kind of create a very clear delineation, but it is challenging.
Yeah.
So, Somil, you touched on something that we haven't gotten to, and I actually do have a couple of subjects we haven't gotten to, but KT, I know we probably have more questions. But talk a little bit, and this would be, I'll put out my bias right off the bat, but talk a little bit about admitted versus non-admitted as a choice, particularly as a startup. And as both of you know, I have a lot of experience in E&S, excess and surplus lines. I have a preference for it because of rate and form flexibility as an underwriter and a prior MGA, but sort of curious on how you think about advising, I say, a startup founder on the choices, particularly if they may not understand the surplus lines market.
I've been doing this for 28 years, Bob, and the pieces of this I don't understand. So let's be perfectly clear that this is not a simple, easy to understand thing, particularly because a lot of the regulation on this is not actually written down. It is in the minds of some regulators. This is a pretty tricky space, okay? So let me step back. Let's talk about what those terms actually mean before we talk about how to pick one, because otherwise this is going to be in a big vacuum. Most insurance, like I said, are regulated at the individual state level. Typically, you have to tell a state, here's the insurance we are providing, here's what it actually covers, here's what it's not going to cover, here's who's eligible to be included in this policy, and here's how much premium we're going to charge. The state then can either approve it or disapprove it or ask you to make amendments, all the kind of fun stuff. Those are called what's admitted lines because the state is kind of quote unquote admitting you. The problem with that is now you can end up in situations where I'm going to use examples, but that are made up, but you'll get the idea where, let's say, because of a catastrophic weather event or series of events, or just a challenging situation where the rate increase, let's say you need to increase rates 20%, 30%, 50% on a very regular basis. For example, I'll give a non-controversial example. When COVID happened, cyber policies, the coverage on cyber went through the roof. Like everybody was working from home without having the proper protocols to do it. And apparently we were signing away all of our money and credentials to anybody who asked for it. It was a bad state. So the cyber insurance rates were literally going up like 50 to 70% on a every few months basis. It was insanity. A lot of state regulators don't like those kinds of increases. They want to protect the consumers. I'm just giving it, right? So they kind of say, not okay. Carriers say, well, we can't write out those premiums, so they back out of markets, and this creates a void. That's where this non-admitted space comes in. And the thought process is states have provided a mechanism for insurance to be created and offered without the state having to approve everything that's done in these extreme situations, right? So that last part is important. This is not meant to be, oh, if I have a choice between admitted and not admitted, I'm just going to do non-admitted. That's not the thought process. The idea is it's only meant for these situations where you don't have an easy admitted solution. Only then you can create that. The gray here comes in. Not all states do a good job defining what is considered admitted and what's not. Some states have explicit lists, whether it's terms of lines of business or geographies or other areas where you can officially write something as a non-admitted thing without having to kind of go through the hoops. But a lot of times you almost have to first justify potentially on an individual policy basis that you could not find coverage in the admitted market, and only then you had to go in this non-admitted route. Sounds pretty complicated. It is. And the reason this becomes such a big thing is if you are creating some really new, novel product, there is no way for the regulators to kind of regulate it. They don't know what they are regulating. There is no loss experience. They don't know what the right coverage is because, again, you are creating this brand new thing. I've created a few products like this, and that's the reason we were very comfortable saying, yeah, we are going to create this as a non-admitted product because we know we're going to have to change rates on a regular basis because we don't have this figured out yet. We're going to have to figure out the coverage pieces, exactly what you mentioned, Bob. You have freedom of form and pricing. What that means is you can change premiums like airline prices. You can change coverage as you need to, right? Because this is not a well-tested market. In those situations, yes, it does make sense. It has its own sets of challenges. Doesn't mean it's the wild, wild west. There is still regulation. Sometimes it's almost more confusing regulation. There's surplus lines taxes. Only certain brokers can write surplus lines products. Sometimes you still need 3 letters of declination before you can do that. So there is more complex things. Therefore, not every answer is surplus lines. if you have a pretty healthy existing market for that particular line of business in that state, you really have to kind of answer the question, why would I not be writing this on an admitted lines basis before you go? These also have multiple names. Admitted is mostly just admitted lines, but non-admitted is also called surplus lines. It's also called ENS, which is excess and surplus. So there's a lot of confusing things all part of this. What did I miss, John?
Yeah, I would just quickly add on here that if you're a startup MGA, and I think Somil kind of talked about this a little bit, but if you're going to do ENS paper, you can, assuming you're appropriately licensed, right? If you're appropriately licensed, you can write really tomorrow. But if you're going admitted, it's going to take, there are some states that will automatically grant authority, but there are many states that will not. You have to wait 3 months, 6 months, 9 months, a year. If you go out to California or something like that, it may take you a year or more to get your filing approved. And it's usually the bigger states that you want to actually get approved are the slowest. And again, to Somil's point, if you found out that you made a mistake, and you can make a rate change higher or lower, it doesn't matter to me which direction you have to go, it's going to take you another 3 months, 9 months, 12 months to actually get that approved. That could be very detrimental to your program and taint your carrier relationship as well because you got it wrong.
Excellent. Thank you for bringing that, John. Excellent points. There's a whole strategy to how you go to different states at different points in time to kind of follow along that arc where you're constantly adding new business, and you kind of have a plan for how long these are going to take. And John is absolutely right. There have been states that the filings were submitted for 2 years and they're still not approved. There's other states that's called file and use and file, which is basically a way of saying you get approvals way faster. Some of them you technically don't even need approval. So it's a state by state game there.
AT, do we have more questions? I know we've been going on. So sorry about that.
Yeah. So from a capacity provider's perspective, how important is pricing or portfolio monitoring for a new MGA? In the first 12 months, should the focus be on actuarial rigor first or more on distribution and underwriting discipline?
This is not an or question, this is an and question.
Yes, Somil, this is you.
Sure. Well, I'm an actuary. This is what I do. So to me, it is very important. And this is the way I stated, right? If you're creating a brand new product, your pricing is going to be wrong. It is going to be wrong. I just don't know by how much and in what direction, but it's going to be wrong. Right. Can you put some sort of safeguards around that? Absolutely. That's really the way you kind of want to think about that initially, is that you know it's not going to be perfect. You work with the capacity providers to say, hey, what are my guardrails here, right? How long can I go? When do I get that early signal, right? If I plan on writing, I'm going to say let's say it's a competitive market, the agent's already writing this, I'm expecting a close rate of 10%, and I'm running 50%, that might tell me I'm way too underpriced, right? So there are these early signals you can pick up on. You don't want to be in a situation where you wrote a lot of business and then later realize your loss ratio was terrible. And it can be later because there are some things called long tail lines where losses emerge months, sometimes years after they actually happen, right? You kind of have to plan for that. So this is actuarial work. This is all doable. This is not a or question. This is absolutely not a question around, hey, do you get your actuarial work right or do you get your distribution right? No, you kind of have to do both. You slowly do both of them right. That's the key there, right? This is why you don't launch in all 50 states day one. You kind of get there slowly. You put you do soft launches. You go talk to brokers and say, hey, if I offer this policy at this premium, do you think you can sell this? What kind of concerns do you have? So you have a lot of those early conversations. When we build models, we do a lot of this testing against, like, hey, can I run competitive analysis against other carriers' prices on the same policy to understand, am I within this range or am I within this range, right? Like those are all things that are very important. You have to do them both right. I don't think this is an optional thing. It does not need to be perfect, though. That's the idea. They will absolutely be looking at your pricing. Actually, they're not going to be looking at loss ratios in the first few months because they won't have any. It's going to be nonsense. But they will be looking at underwriting audits, for example. They'll probably literally pull up your first 10 policies and go through each one of them and make sure you're actually doing the inspections if it's a property coverage. You're pulling all the reports if it's casualty. So they're going to want to make sure that what you said you're writing in terms of coverages, in terms of are you putting in the right paperwork? Are you getting the right signatures on there? All of that is going to be the most important thing when you first writing, because there is no actuarial data. But if you're doing all those things right, more likely you'll get the actuarial numbers correct. And then you kind of go through and cycle through and kind of repeat that process a few times.
Yeah.
KT, do we have more questions?
We do. What are a few commonalities in the product market fit that you've seen for successful MGAs?
I've been talking a lot, John. Why don't you take this one?
Maybe restate that question for me.
Well, it goes on to say unlocking a new market, new data tech approach to existing market. So they're looking for commonalities in product market fit for successful MGAs.
I'm not exactly sure what that means. Somil, do you get it?
Yeah, I'll take a stab at it. It doesn't mean I got it right, but I'll take a stab at it. I think the question they're trying to ask, among all the successful MGAs, when you see product market being done right, what's been common to all that? Like what do people tend to consistently get right? The size of the market, I would start there. How big is the TAM? Everybody's going to want to know that, both your investors and your capacity providers. This is a really interesting, tricky question, because tech people seem to think if I don't get 400% growth year over year, it's a failure, right? That's a common approach, because that's how a lot of the tech products were evaluated. That's not insurance. That is not how insurance works, right? So yes, growth is important. Increasing policy counts are important. All that is good stuff. But think about the process of getting there. What's your roadmap to getting to 10 million, 20 million, 50 million, 100 million in written premium, as opposed to how do I get there day one? You're not going to get there day one. You shouldn't be getting there day one. In terms of product market fit, do the research. It's really the same as any other market. I don't think insurance is particularly specific in that way. Do the research in terms of understanding the market size. Do the research in what's the price point where this works. I guess the insurance specific angle is it's not just a price point in terms of will the market buy it, but you also then have to make sure, does that get me to a reasonable loss ratio? And it's not, and you can kind of tweak all of those pieces a little bit. For example, like if the loss ratio is not right, can you maybe scale back on some coverage? Are there coverage pieces that you can make optional or buybacks as opposed to being part of your core product? Can you make can you change the limits on these things, right? So there's different ways that you can reduce or increase coverage, different ways you can kind of do the same thing with the premiums. There's sometimes where the premium may be right from a loss ratio perspective, but you as an MGA may not be making any money. Maybe there's things you can do with policy fees that helps kind of offset that. So there's different ways of making the economics work, but from a market product fit perspective, it's really the same as any other product. Do consumers want it? Is there a big enough market? What's the price point where I can make this happen?
So
it goes back to the differentiator, right? What is your true differentiator in this marketplace?
Yeah, and let me add a couple of comments to that. So I think the concept of product market fit is not actually wholly applicable to insurance. The way I think, and it's certainly an investor or venture concept. So the way I think about it in insurance is if you look at a completely new insurance product versus an MGA starting say a new product in an existing market segment, they're different. So a new product, you obviously have the issue of whether people are going to buy it. And so your competition is not like most of insurance, other insurance underwriters. It's also not buying. And in many cases, not buying the coverage is a huge competitor. And so in that sort of realm, the concept of product market fit is really important. And Somil was getting at like one of the core pieces of that is balancing pricing that would encourage people to buy with underwriting profitability, which is the core of what an MGA does. But the other point I was going to make for MGAs, particularly say someone who's used to a more traditional venture approach and is trying to start an MGA with a product that's going to compete in a traditional or existing market segment, the concepts I tend to focus on, being a long-time distributor, are hit ratios and renewal retention, which are core insurance terms that non-insurance experts should become extremely familiar with. Key metrics, details. So I'll stop there. KT, what else we got? I know
I
we're
think
sort
we
of.
have time for one more.
I'm going to add one quick thing there, Bob. Thank you for bringing that up. Not only those two terms, but really all insurance terms like that. Get comfortable with that before you have the conversations with capacity providers, because they will ask you questions. You do not want to give the wrong answer. Sorry, Katie, go on.
Yep.
Great point. I think we have time for one more. And so we'll go with, what are the biggest regulatory hurdles when launching an MGA?
Well, let me take a quick stab at that. So I think that first and foremost, everybody, I think that what you need to recognize is that the term MGA is an overused term in our space. What we're really talking about are producers. So what I recommend to everybody that I speak to, for the most part, is that you don't really want to be called an MGA, but that is a term that we use rampantly throughout. So please disregard all of that. So you don't necessarily want to be considered an MGA, because if you become an MGA or licensed as an MGA in a number of different states, you then fall into another regulatory hurdle that is required, and your program will be listed within the yellow book of that carrier. And I often look at that as a potential disadvantage. Now my competitor knows how much premium I have, what my loss ratio might be. All of those kinds of things are sitting there. Somil, what do you think? What else do you have?
Yeah, so there's a few different sides to the regulatory thing. Like from a producer perspective, you need to make sure that either you or somebody else that is typically part of the founding team is a licensed producer. It's not an absolute requirement, but I highly, highly recommend it. It helps tremendously. And it's relatively easy to do. I would just recommend it. You learn a lot about just insurance and the business of selling insurance from that process. So just do it. Suck it up, do it. Then there is an actual MGA licensing. John's right. In the terms of what we're talking about, you actually don't need it. Don't bother. There's 15 states or so that actually require it, but nobody really requires it. You don't bother. Move on. You need licensing in the sense that the carrier, the fronting carrier, needs to be licensed. There's no way around it. They will get licensed. If you are writing surplus lines, and there's other regulatory pieces that come into play, such as you have to not only have a producer's license, but you need to have a producer's license that can also write surplus lines. You need to do surplus lines taxes. You need to do reporting, which is probably even more annoying and painful than the taxes themselves. So there's that set of regulation. If you are not a surplus line, so if you are admitted, then you have to do all the regulatory filings on a state-by-state basis. You have to file your forms, your rules, and your rates. Some states require you to file underwriting guidelines and tiers. Again, varies by state, so all of that stuff happens. So there's different kinds of regulation and different kinds of filings. They happen at different points in time. They happen with different pieces. That is all procedural. I wouldn't worry about that too much, because like if you talk to the right person, they can walk you through all of that. That's not a mystery. It's confusing, yes, but it's not you don't need to worry about all of that day one.
So we're at the top of the hour. I will pass to Bob to wrap up, but I will share, since looking at the questions in the chat, that there are definitely some specific questions for folks that have more, individual needs. Both Somil and John have agreed to be a part of our monthly office hours program going forward, where for 1 week a month, some of our experts will allow you to book free 15 to 20-minute meetings with them. And again, both Somil and John are on there. So head over to the new website, look at that monthly office hours page. And if you have individual questions that you want to follow up with either of these gentlemen on, their meeting links are there.
Great.
Feel free to reach out. Happy to help.
Thank you, KT, and John and Somil. Thank you very much for sharing your wisdom with everybody. And We will be doing this again, not just for MGAs, but other initiatives and topics we have going on at ITA. So those of you who are members, thank you for attending, and we appreciate any comments, ideas, suggestions you might have. And for those who are not ITA members yet, we would appreciate if you would join and support the community. Thank you very much for attending.
Take care. Thank you, Bob. Thank you, KT.
Thank you for hosting, Bob.